Welcome back, guys, to the final installment of the Keep It Simple series, part 5. First of all, I want to start off by saying thank you very much to everybody that has given us love and enjoyed the content through the series so far. This is, of course, the final installment, so if you haven't already watched part 1 to 4, then check those out. The link for those is in the description down below. Now, in episode 5, as many of you know, we are actually going to show you a real world way you can apply all of the concepts we've shown you until now, keeping it simple. What I would really recommend is not just watching part 5, but going back and understanding the principles and gathering the foundational understanding you need to really fully comprehend the simplicity of this and why it is you're doing it in the way you are. Many people just want to skip straight to the doing it, whereas it's kind of like doing the final exam without doing the paperwork first. You really need to put in that work and learn the first points and the very raw mechanics to be able to then apply it with a full understanding and comprehensively have an A to B of what it is you are actually doing. First thing first, if you're not already a member of the YouTube, hit that subscribe button, hit that like button. We appreciate it massively. Of course, if you want to be a part of the Discord community, you can find the link for that down below. So without further ado, let's get straight into it. Now, as always, we're going to start off with a diagram section and we're going to focus on the core principles, which is money in, money out, and we can understand how we can begin to capitalize on this principle. The key element here that we really need to focus on is the perception of the order flow itself. So it can be perceived in many different lights, and this is all going to be dependent on your time frame. Okay, so it is down to the fractal nature and understanding of the market, but the main principle here is that you need to choose a bias time frame. So a time frame you're going to get your directional bias, whether that is up or whether that is down. So that's going to be T1. Okay, we need T2 to define points of interest. Remember, points of interest is not an area we are definitely going to trade from. It's a point we would be interested in possibly taking a trade from if price action allows us to get to that point. And then we need T3, which is our entry time frame. Our entry time frame. So we have each of these lining up 1 to 2, 2 to 3, collectively giving you a full comprehensive understanding of where price should be going if certain criteria are met. So for this example, we're going to be using the daily, we're going to be using the 1 hour, and we're going to be using the 15-minute. Now you, of course, can work around whatever it is that you would like. You can use 15, 1 minute, 30 seconds. There is going to be, and this is very important, there is going to be some time frames that really don't mesh together very well. So for example, 30-minute and like the 1 minute is not necessarily going to mesh together very well because you're going to have a misconception of where you stand on the higher time frame down to the lowest time frame. You could of course use 15, 5 and 1 or smaller time frames collectively. Or if you look at this, this is sort of a comprehensive move because the daily is going to give you more of a weekly directional bias. The hourly is going to give you like a daily trading session bias, and then your 15-minute is going to give you an individual window within that sort of time frame. So you're collectively working your way down to a movement that could occur during the space of a day. Whereas like a movement on the 1 minute, for example, can chop and change very quickly. But using this simple methodology, you will be able to define 3 time frames that you will be able to use it with. And of course, take everything I show you and use it how you want to use it. If you do find timeframes that work really well together, then please do join the Discord and share your findings and work together with the rest of the community and find what works best for you. But this system is so simple that it is really easy to apply, and it allows you minimal time on the charts in terms of analysis, simply waiting for that right moment to come. So what we're going to be doing here is we're going to minimize this chart down to nothing. Okay, so we can all agree that I can't see what is going on here, and you guys can't see it either. Now we are going to be staying on the 1 hour time frame here, because if we go to the daily, we will go too far back and the data will not load for us. But we're going to just go to a random point in price. So we're just going to, let's say we'll go 6 scrolls back. So 1, 2, 3, 4, 5, 6. We're also going to delete any drawings. And then we're going to go one more time, and that brings us to June, the 17th of June. Cool. Let's go from here. So this now is going to give us a very simple starting point. We're going to go to our daily time frame to establish our daily bias here. So the first thing we're doing now is just going to go to the daily time frame, like we are, and we're going to establish what direction is Institute traveling in at this time. Well, remember the key element here is on the daily time frame, on the hourly and the 1 hour, the 15 minute, the rules still apply. There is no change in the rule set, and the rule set is always this. For Institute to be involved in trend, they must first be involved in counter. So you must see a counter trending move appear before a trending move. So to see a bullish gap and take it as a valid point, you want to see a bearish gap. Now, in the case of your bias time frame, which is what we're on here, we're only going to be looking at the most recent. So for example, if we didn't see this gap and we were here, we'd be looking for bearish. Okay, so it doesn't really hold the same relevance on the daily, but it is still important to see and understand that principle. So we have right here a bullish gap. So straight away we have a bias for bullish. Now we can come down to the hourly time frame. And on the hourly time frame, we're going to establish points within here that hold relevance for us. Now, how are we going to do this? Well, we're going to do it very simply by looking at the same principle I told you guys a second ago. So we want to see institution down, causing spaces to the downside in the market, and institution up, causing spaces to the upside in the market. Without the institutional up move, we cannot confirm that they are back into the position to go higher or follow trending, which is the daily time frame bias. So there is a couple other things you can do, but we'll get into those at the end of the video. So right now, we have a bullish gap here, which was confirmed. So it means price action is most probably going to go bullish from this point, and we will go solid green. And we've established that we are within the first candle established before this gap formed. So we know that orders are most likely sitting here, and the structural point below is where the orders sit or institutional movements to the upside. So there is two options for this. The low sitting below the candle that causes this gap will either be swept or it will be left. This is why we use the 15-minute time frame to confirm our entry. So at the moment, we actually have already tapped into here. So I'm probably going to wait for the next space to arrive. So what we'll do is we'll play forwards. I don't want to go down here and hindsight any moves. We're just going to play this forwards, and we're going to go till the next space. Remember, we should be seeing bullishness from here. We'd be looking to target this and this high. Okay, so beautiful bullish expansion from that space. So now what we're doing is waiting for a bearish gap to form like now, and we're going to wait for the next bullish gap to arise. Remembering that during this back testing here, we aren't actually aware of any fundamentals, and you would of course have to factor that in, as well as market close and off session trading. So for example, during a back test, you may see something that happens, you go, wow, look at this trade, when really it's well out of your trading hours. So keep that in mind, but we're using this to show you as a principle of price action movement, not as a look at this amazing 1 to a million trade you could have caught. Okay, first gap has formed. That's brilliant. So now we can look towards this space here to be tapped in, and we can go down to the 15-minute time frame. Now we have an option here. We either wait for price action to pull back into here, and we wait for a 15-minute gap to arise, and then we can go long out of here, or we wait for price action just pull back, deliver a bearish and then a bullish space, and then we go long off of that. Now again, how you want to approach this is completely up to you, because there will be times where price will not pull back down to here, and there will be times when price does pull back down to here. So how you approach this is completely up to you. For this example and for this overall scenario, I'm just going to show you the principle of price action making a gap down, making a gap up, and then we're going to trade off of that principle there. Now, I've said this before, where you actually decide to trade from, where your stop losses are, how much of an RR you target for this, what kind of risk reward you use is going to be down to you. I'm only showing you the raw basic concept of this, and it's down to you to personalize it, because trading is personal to you. You can have the worst system in the world and price action disrespect it constantly and someone still make money. You can also have the best system in the world and price action always respects it and people still lose money. So it's always down to you. Personalize it for what suits you. You are the defining factor here. We're going to fast forward now. We're going to look to see if we can get a downwards move. Now, in this case, unfortunately, price action simply went bullish immediately. Now, another scenario here is if we're on the 15-minute, there is a third entry scenario you can use, which is when price action delivers a bearish gap down, so it's showing institutional down, we can begin to find that institutional up and just enter at the point of this being formed, using the structure as your stop, and the entry point is the gap forming, so it doesn't need a pullback to go long. But preferably it is a bit better to do the pullback scenario, as it gives you a more refined entry, and it also allows you to actually keep a much tighter stop and a much better RR. So let's just move on. We've hit our targets here. So did we hit the high? No, we didn't. So we can stay on the 15-minute for now, actually. Let's just see. We did make a bearish gap. Let's see if we have a chance to follow this higher here. Okay, we come flying back down. Keep in mind that's the last point that we highlighted. So price action actually bouncing off of that. Pretty good there. Still waiting for an upside shift here. Okay, upside shift. So let's just go and confirm on the hourly that we don't have a bearish gap. Okay, we do have a bearish gap. So we need to wait for that hourly gap to form. That's fine. We don't want to jump in too early on this. Now let's just see if that tapped into that area there. I believe it did. It did actually tap in perfectly. Whether you want to trade against that hourly gap is going to be down to you. I personally would wait for a bullish gap to appear. When the bullish gaps appear, if the bullish gap appears. Right there. This is where we can begin to do the same thing now. We look for a bearish move. Go back to the hourly and mark this space up quickly. If we see a bearish move come out now, like that, we now look for the next bullish shift to appear. Right there. And we can say that by probability, the chances are we should see price action coming into this and playing bullish. This is based off of the principle you're not waiting for a pullback into the hourly area. Okay, nice. Pretty much a perfect push. Now, I did for a second there think that this was going to push back through into this low, which would be fine if it did. But we have literally seen a perfect tap in and a push higher. Now, this is on the 15 minutes, so you could, of course, bring this into lower time frames and refine an entry if you liked. But it is really that simple. We go to the daily time frame. We define what direction price is traveling in, up. We go to the hourly time frame. We wait for the confirmation of institutional out to institutional in. So in this case, institutional out, institutional in. We find a space. Institutional out, institutional in. There's a space. Institutional out, institutional in. We find a space. Institutional out, institutional in. We find a space, or we confirm it on our entry time frame. We can continue doing this, and I will show you for a couple more examples, and then we'll cover some other points that you can add in or change, and that will be the end of the video. Let's go and see how far this runs. Remember, because we'd be bullish here, we'd be targeting this high that was taken, this high that was taken, or sorry, not taken, this high that was taken. This high would be our next target, as it's somewhere we want to be taken. So let's just play this here. Okay, price just runs straight through it. Notice how we've barely drawn anything. We've drawn a couple of boxes and a couple of lines, which is where we're targeting. Okay, we're waiting for that bearish gap. And now this is a great opportunity here to show you what I mean in terms of when you see a change of institutional out to institutional in, look how long after this gap, price has just run bullish, 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 bullish. It's not even looked back. This is why what entry model you use, refining the actual entry of this is going to change whether you catch this big move or whether you don't catch this. If you're waiting for a pullback to the hourly, you wouldn't have got that. Trading the direct order flow off of that shift, it has given you the entry. So let's just have a look on the 15-minute here. If you were to trade from this point, you've had pretty much a zero drawdown move that has given you a complete trend expansion following the daily bias. Following this up here, you can see the same thing happening. Institutional out on the 15, institutional in. Price pushes away aggressively. institutional out, institutional in. Price pushes away aggressively. The same thing is going to happen consistently over and over again. So what we're going to do now is we're going to go to the hourly and we're going to wait for our next shift to happen. And we're going to see if we can get that to line up as well. So let's just go to the daily and make sure we're still making bullish gaps. Yes, we are. And again, this is a completely random point in price. You can go and test this yourself. It's so simple. It takes so little amount of time to actually do this. So it's not something that, it's going to take you hours to mark up every point previously, and you can have inconsistent analysis. It's so simple. Hourly, right? Let's see if we get a bullish space here. Bullish gap, perfect. There's our space. Go down to the 15-minute. Now remember, we have two options. We either wait for a price to pull back, or we just simply trade the gap out to the gap in. Let's see where this goes. No gap down. Right, there's a gap down, and we're tapping into here now. So if we get a gap out, we're going to look to follow that long. There's a gap right there. So by probability, we know we should see price action play bullish from here. Let's see if it does. Beautiful tap in and a crazy expansion to the upside. Crazy expansion. Now it was very, very tight tap in, but it's definitely a tap in. So I think I've proved my point just by showing you a few days on UJ. And like I say, please take this example and go and test it yourself. It's not something that I am showing you that's so complex it will be hard for you to apply. It is a simple 3-step understanding that order flow and momentum is traveling in a certain direction, and probability is staying on your side, that you are going to be able to follow the direct movements in the market rather than chasing structure and analyzing things that really don't have a huge amount of relevance for you until price gets there. These points truly hold value in the market. Now, there are variations that you can use in this, and the variations would be the following. On the daily time frame, you define your bias. Again, this bias time frame, POI time frame, and then your actual entry time frame can be completely unique to you. So from here, if we have a bullish bias, great. We can go to the hourly, and you can apply the same principle that we just looked at, but you can look at liquidations. So look at major lows, like so. Look at major lows being liquidated, and at the point of these major lows being liquidated, like here, let's just see if it actually has a valid point to show you here. You wait for the liquidation of this. It actually was the same point. So you then wait for a gap to appear, and you would trade off of, so for example here, you trade off of this gap. Okay, so first gap after a liquidation of a major low on the higher time frame, we'd now expect price to play off that and go bullish, and as you see, it taps in and runs bullish. Now we know that it pulls back, but the principle remains the same. So you can apply the institutional in, institutional out bias to major highs and lows. You can apply it to weekly point. You can apply it to swing trading, scalping, intraday, you name it, you can apply it. So guys, part 5, probably the easiest part of all of these series so far. I hope you've enjoyed the Keep It Simple series. And remember guys, if you aren't a member of the Discord already, I really appreciate everybody that joins and shares their backtesting and work and grows as a collective. We have a huge amount of members in there. And of course, if you have enjoyed this video, hit that like button. All of the relative links are down below. You can find them there. And I will catch you all in the next one, guys. Peace and love. Enjoy the rest of your week.